Hello, everybody, and welcome to our channel, Accountancy Bridge Coach. So, in today's video, we are going to learn on golden rules of accounting, and we are going to answer three areas of this golden rules of accounting. Just to brief, it is I hope you would be knowing that golden rules of accounting is the base for journal entries, right? What are journal entries? It is the first step in the process of accounting, right? So, this is what we are going to discuss in today's video. I have divided this into three parts. So, first, to learn on why these rules are actually required, then next we are going to learn on what are these rules. If you know the why and what of any topic, then how to apply would be very easy. However, in order to make things simpler, I will come up in the next video on how we are going to apply these golden rules of accounting into our journal entries, or that is journaling of our transactions. So for this, we'll come up in the next video. So in today's video, we are going to learn about why and what of the golden rules of accounting. When we start to understand the golden rules of accounting, we need to understand the classification of accounts. So, accounts are nothing but set of transactions which are similar in nature are grouped together, and that is what we call it as account. So, these all these accounts are classified into three major categories. One is personal account, real account, and nominal account, right? So, the golden rules of accounting, depending on the nature of the account, differs. Let us see that in detail, but for now, focus on what are these three classifications of personal account, real account, and nominal account. In order to understand about these categories of personal, real, and nominal account, I would like to explain you on what is this financial statement. So, financial statement comprises of two major categories. One is transactions which are short term in nature, that is, which expire within 12 months, and those transactions which are long term in nature, the benefits or obligations of which extend for more than 12 months. If you have not seen my earlier video on revenue and capital expenditure, I would highly recommend you to watch it, which I have linked above, because that is very fundamental in understanding of all the concepts of accounting. So now what I have said is these financial statements, the transactions could be classified as one short term in nature, that is, the benefits or the obligation expire within 12 months, and those which extend beyond 12 months. So, those which are short term in nature are only those which are covered in trading profit and loss account. How does this actually help? So the trading profit and loss account tells the profit or loss of the business. So depending on whether the profit or loss it is for that particular financial year, we know what is the performance of that particular entity in that particular financial year. So those transactions which are short term in nature are combined and put together in order to or put together in trading profit and loss account in order to ascertain what is the performance of that particular entity in that particular financial year. Whereas those transactions which are long term in nature are put together in balance sheet. Balance sheet is nothing but it is a position statement. What is the meaning of position statement? That means as on that particular date, whatever is the balance of whether it is assets or liabilities is being shown in the balance sheet. So I hope that you are able to understand what is the components of the financial statement. So one is the short term nature transactions and the others are the long term nature transactions, and this gives rise to trading profit and loss account on the balance sheet. So having understood this, now let us identify what are these three categories of the accounts. All the accounts which are pertaining to trading and profit and loss account are nothing but nominal accounts. So when I say nominal account, it include all your incomes and all your expenses. So all these incomes and expense are categorized as nominal account. And all those accounts which are relating to balance sheet items, right? Those are can be classified as personal accounts and real accounts. So, what are these real accounts? Anything with respect to assets or liabilities is called as real accounts. Okay, so what is asset? Anything that the company owns is an asset. Whereas what is a liability? Anything the company owes is a liability, right? So assets and liabilities are categorized as real account. And what is a personal account? Anything which is personal, person, as the name suggests, right? Like your sundry debtors, creditors, individuals, right? Owner's capital, drawings, anything which is pertaining to any individual. Okay, all those are personal accounts. So personal accounts would also be in if there are any representative, right? Representatives, it also includes them. So this is a brief overall picture on what are these nature of the what are these classification or categorization of these three accounts. That is, one is personal account, then the real account, and nominal account. So if you see the big picture of what is a financial statement, all those accounts which are relating to trading profit and loss account are the nominal accounts, that is incomes and expenses. And as part of the balance sheet, anything which is person related or all personal accounts like sundry debtors, creditors, owner's capital, drawings, and all, anything which is real, that is assets and liabilities, are all real accounts. So assets you would already know, right? Fixed asset, your cash, bank, then whatever is the stock in trade, all these are assets. And what are the liabilities? Liabilities would be like anything which is liable, expenses payable, salaries outstanding, etc. With this understanding, now we will proceed further on what are these golden rules of accounting. Why we need the golden rules of accounting? It is mainly because if all the companies and entities which are preparing the financial statements, right, follow a specified way of preparing the financial statement, then what does happen? It helps in uniformity, and so the entities can compare its performances against the other entities or the competitors. And also it helps in understandability of the financial statements for their own owners and the shareholders. For these two reasons, these golden rules or set standards are being followed, so that it makes things easier, right? Whenever there is a code of conduct, it is very easy to manage things, right? You always plan things ahead before you execute. Similarly, if you have a set of code of how to do the process, it helps in easily preparing your uh, financial statements, and also in comparing between the performances across other entities as well. So that is the reason why we are having this golden rules of accounting. Moving on to what are these golden rules of accounting. So when it comes to all those accounts which are personal in nature, then what is the rule says? Debit the receiver, credit the giver. This is what the golden rule says. That means if whenever there is someone who is receiving any anything, then whoever is the receiver, if it is a personal in nature, if debit the receiver, credit the giver. So the first step which you need to identify is whether the nature of account is personal in nature. Say for example, owner's capital. So in all your basic problems, owner contributed capital would be the first transaction, right? So this owner's capital is a personal account. So the owner itself is a personal account. So what happens when the owner contributes capital to the entity? So as we know, the business entity concept, entity is different from the owner. So what is this? From the entity's point of view only, we are preparing the books of accounts, correct? So owner who is contributing capital, right, to the entity, that means who is the owner? Owner is the giver, right? And entity is the receiver. So what happens? Owner gives the capital and entity receives it in the form of cash, right? So you see that this owner is what nature of account? It is personal account. So what do we do? Credit the giver. So this is an example of where there is a personal account involved, and The personal account is the owner's capital, who is the giver, and hence this account needs to be credited. Okay, this is what personal account rule says: debit the receiver, credit the giver. The next is, what is the rule for real account? Real account rule is debit what comes in and credit what goes out. That means what? Whenever any account is real in nature, like assets or liabilities, then what you need to apply? If there is an asset coming in, when an asset is coming in, then what you do? You are debiting the asset. When you are selling an asset, what happens? The asset goes out, so you will credit the asset, right? So in this case, in the first example, owner contributed capital. You see that entity received cash. Cash is what? Cash is an asset. Asset means what? It is a real account. So in this case, what happens? What would be the journal entry? The cash is coming in. That means I am debiting my cash account. So the entry would be like, as how the rule goes, I am debiting cash and crediting the owner's capital, right? And the third rule, as we already have discussed, anything which is nominal in nature. So, in a financial statement, those which are pertaining to trading profit and loss account, that is, any income or expense, would be categorized as nominal account, right? So, what does the rule says if it is a nominal account? You need to debit all expenses and losses, and you need to credit all incomes and gains. So, whenever there is any income, or when you are selling an asset and you incur a profit or a gain on a sale of an asset, then all those would be credited. And whenever there is an expense like your payment for your salaries, payment for your wages, or any expenses, admin related, child sale related, marketing related, would be debited. So this is based on this rule of, if because it is a nature of income and expense, that means it's a nominal in nature, you apply this particular rule. So these are in brief the golden rules of accounting. And when we apply these rules in for every transactions, then we end up in passing the journal entries. So the first step would be to identify the nature of the account, and the second step would be in applying the whatever is the rules of accounting. So if these two are being followed, then the journal entry would fall in place. However, I would come up in detail on why is this particular account rule given in this way. So I hope this was a value add. See you soon in the next video. Thank you.